Good evening, everyone. I hope you are doing well. I hope if you've had any submissions, that they've gone well so far. I don't know if you guys have any questions. I was thinking about covering the theory and learning unit 8. I know you might still have a few questions about the graphs in learning unit 7, but I'd actually like to consolidate, sort of do like a graph lecture just between these two learning units as well, possibly the next one as well. But just specifically focusing on those graphs, because I'll show you during today's lecture, we'll cover it, just the basic concepts. And then you can go and I'll send out an announcement for just an activity, just to make sure that you are grasping the graph aspects. And then we will do one consolidated lecture as well, just to close off any knowledge gaps. Okay, before we start, I'll take 5 minutes. Have you guys heard anything interesting in the markets? Let me just open up here so that I can see. Please, there's not a lot of us in the room, so if you want to open your mics, please feel free. So far, we have some tariff deals that have gone through. We've currently sent a South African delegation to the US to work on our trade relationship with them. Hopefully they're successful, because we are members of AGOA, which is it's the African government. I can't remember exactly what it stands for, but it's AGOA if you want to do some research on it. And what AGOA does is it allows us, it used to allow us essentially tariff-free access to the US market for our products. Obviously, now that has come to an end, despite the fact that the tariffs have been postponed. So we are waiting with bated breath to see what happens. We've also had some people who have recently immigrated to the US and are now currently like resettling there. That's quite exciting as well. It'll be quite interesting because, in South Africa, we have quite I would say, a bit of an oligopoly with regards to the agriculture industry. So it'll be very interesting in a free market in a few years to see how, the farmers have sort of resettled in a free market. It's just a very nice case study to evaluate whether they are, meeting with success. Is it, or are they, struggling in that sort of open market environment with no protections at all? Because in South Africa, of course, we still do have quite a few government protections, whereas there is far less, shall we say, parachute infrastructure in America for the free market. Okay, so yeah, it's going to be some fun times ahead of us. It looks like if the tariffs are sealed, it's looking very positive for the US market. They seem to be going up quite substantially they seem to have recovered all of their losses from from earlier in the year, and they seem to be making new highs. So we're going to be discussing different market structures, and that's why I like to, just open with the US is one of our best examples of a sort of a free market. We do have other markets that maintain like perfect competition. We have oligopolies, which are, if you can think about our banking systems in South Africa, we have a few number of very big banks. We don't have, like a lot of developed countries, a large number of sort of small regional all the way up to like national banks. So we're just going to be taking a look at those different market structures. Of course, you do also have a monopoly. We experience that, and both the upsides and the downsides with regards to things like Eskom. So it's a single firm dominating the market, obviously government protected, but there is a significant barrier to entry. Of course, you need to be able to generate about 100 megawatts of power. That's what you're allowed to sell. I think actually that was expanded last year, just before the GNU was announced. So it made it more profitable to be able to generate your own electricity. In fact, there are some people who were so effective at doing it, they got off the grid, started generating their own electricity, and then because they were essentially creating a surplus, they were pushing it back into the grid. Which was, phenomenal and wonderful and allowed us to stop a lot of load shedding. I'm not saying that's the only reason. We all know that they increased our rates. They also burn a lot of diesel. But for a while, it looked like everything was it was going well until the
Yes, I am too. I'm not need to miss.
oh my, relax.
Umthetho womthi uleyo singubo ukuze umthetho ubhadala for how many years? 3 years.
Sorry, Nolwazi. I'm not sure if that was intentional or not, but if you want to ask a question, please unmute yourself again. Okay, so obviously the upside to having Eskom, for years we benefited by having a very low price of electricity. So because we were the market maker, the price maker, we had significant advantages. They also are a strategic industry. So, the economy is linked to Eskom. So having a lot of private companies running your electricity grid is also quite a dangerous thing, as a couple of developed countries have encountered as well. So there are advantages to monopolies. Generally, though, it tends to result in a welfare transfer eventually from the consumer to the company, as we ourselves have seen. Okay, many companies suffer this. For example, the monopoly that was dominating industries for a while was OpenAI. When they introduced ChatGPT, they had a single monopoly. It didn't last very long, but they were the price maker. There was no competition for them. The problem is, I'll show you that when you make superior profits, you do encourage a lot of competition. So you encourage other entrants into your market. Then, as we discussed, an oligopoly is more about like our banking system. Products are pretty much homogenous. One bank account is not very different from another bank account. I'm sure you guys, if you haven't seen already, you will see that the offerings are pretty much the same. Even the discounts and the perks are pretty much standardized across the industry. There is strategic independence amongst these firms because they are not allowed to collude with regards to the pricing that we pay. And we have some of the highest banking fees in the world. But in Africa, only half our population is actually using the formal banking system. So, haha. So, perhaps if they dropped their banking fees, more people would be involved in the formal economy. Okay, so perfect competition. This is essentially the stock market. Okay, you are buying a share, you are buying a piece of a company, but it is a homogenous product. You are buying it specifically because you are buying a piece of the company. It is free to enter, free to exit, more or less, you know what I mean? Profits and losses excluded, as well as fees, but in a perfect world, it would be free to enter or to exit. In an ideal world, we also do say, you guys may have encountered the expression, if it's in the news, it's in the price. That refers specifically to the stock market. So if you're hearing something in the news, it's already been priced into the share. So that goes to an assumption that we make about the market, and that is the information is perfect. And that what that means is that everybody has access to all the information at any time, and all of it is reflected in the stock market. Okay, that is based on the capital market hypothesis. I won't bore you with that, but essentially, they make a few assumptions that all investors are rational. And when a few decades ago, when most of the trading was institutionalized, this was very much the case. Or investors were very predictable because they'd all been institutionalized. Everything had rules. All the hedge fund managers operate in the same fashion. So the market became very predictable. But with the increase of retail traders, you have more irrationality, more people taking big risks. A lot of liquidity injection comes into the market. So this perfect competition market sort of allows for the best ideas to sort of get funding. Obviously, there's always a shortfall, a diminishing return. As we learn with economics, pretty much everything has a diminishing return. So there is always a point where this is a good thing, where monopoly is a good thing, where an oligopoly provides you with advantages. For example, during the credit crunch of 2008, I'm sure you guys don't remember it. You probably don't have anybody who mentions it, but they still talk about it in America because it was, and the UK, and a lot of these, even the French market was so badly impacted. So the thing that saved us during that subprime mortgage loan was the fact that we had an oligopoly banking system. So at the time, we only had our four big banks. And because they needed to essentially suspend credit, we weren't trying to, legislate 2,000 or 20,000 plus banks like free market systems would create. We have only the four banks. So government just said, whoa, okay, there's a problem. Trevor Manuel was still in charge at that point, and we still had a budget surplus. So he immediately shut down the credit, issued new consumer credit, the Consumer Protection and the Credit Acts, and they saved us. Okay, I don't think many people would say that perhaps now, diminishing returns. Then there's monopolistic competition. So this is essentially where we are with let's see, maybe our app stores. With Apple, for example, there's a huge issue here because there's many firms selling differentiated products. But for example, if you have invested in an app and the Apple Store rejects your app, you cannot reapply with that app. So it's a lot of fixed costs in the form of research and development that can get thrown away, which is why the Android App Store always has so many more apps available. They are differentiated products, and there it's relatively free entry and exit. You can make quite a simple app. If it happens to be popular, you benefit without having lost too much, core investment. Okay, so we're just going to look at them in a little bit more detail because these things are obviously very easy to examine. So when we're looking at defining perfect competition, we have a homogeneous product. So all firms are selling exactly the same product, making them perfect substitutes for one another. So like I said, the stock market is a perfect situation there because, you can, in a free market like America, where there's like 5,000 different companies to invest in, you can find a perfect substitute for, any share that you're going to buy there. There aren't a lot of homogeneous products. Let me just think. If you guys can think of anything. I was thinking wool for a second, but then I remembered there's mohair, and that's a whole other, I suppose, bread in some communist countries. All the products are essentially, or maybe salt, although now some salt companies have started differentiating themselves as well. But essentially, when you're defining a perfect competition, all your products are exactly the same, homogeneous. You have free entry and exit to the market, no significant barriers. For example, nothing like the exact opposite of our electricity market at the moment. There's a large number of buyers and sellers. No one participant can influence the market. You can see how the stock market here is still falls into this category. However, the digital currency market, not so much, because of the size of that of the like Bitcoin. Okay, Bitcoin is the biggest constituent of the whole digital currency market, but I think the last I checked, it's probably gone up significantly now, but it was only about $400 billion for quite a number of years. And when your market is that small, where you have these large investors, people who started mining early and benefited from this massive return on capital, they could move the market simply by moving their shares around. So one single participant could actually move the market. And we saw that with Elon Musk when he started buying Dogecoin. And then all of a sudden, everybody was buying Dogecoin. We saw it with the Hawk Tower girl, Haley. She was one single participant able to move a market. So that is in direct contravention with a perfect competitive market. It's more of a monopoly. You're taking advantage of your consumers. Okay, and then of course, perfect information, which is a market assumption that we currently operate on and have for centuries. So yes, the stock market is one of the perfect competition markets. Okay, so there is price taking behavior. The reason is that you yourself cannot set your share price. You will issue your shares at an IPO, an initial market offering, an product offering. Okay, so you would provide investors with a prospectus. You'd get a few people to maybe underwrite your shares, but you have no influence on the price that your share is in the market. So you are a price taker. And because there are such close substitutes, it's quite an elastic market. So the market, that's essentially why the stock market is so perfect, because if your price runs too high, or we find something that devalues the prospect of your share or your company, your stock price will drop irrespective of, it's more perception that runs your market. It's expectation. So it is all price taker behavior. You have no influence. During the dot-com bubble, pretty much everyone went out of business, but some companies managed to survive. Why? Because Amazon, for example, understood that they were a price taker. So despite the fact that the company itself was a beautifully well orchestrated machine, the share price, the sentiment had changed in the stock market. So everything suffered, but the business itself, it was completely separated from its share price. So it continued to grow and become this behemoth. And then the stock price caught up when people sort of realized the perfect information aspect, where we started to realize what Amazon was actually worth. Okay, so the implications of that is that any individual's output decisions don't affect the market price. Okay, so the demand is a flat horizontal line. It has nothing to do with, you cannot influence your price. Okay, so just a little bit of revision. Okay, so this we do cover briefly in Learning Unit 7, but just to restate it here, when we look at the cost curves, we're concerned with marginal and average costs. Marginal costs are always the cost of producing one additional unit. Okay, marginal means one additional unit. It typically manifests as a U-shaped curve. Okay, and that is due to the initial increasing and then diminishing returns. So initially we hire one person and they produce up to 10 units of product for us. Okay, then we say, wow, that's fantastic. We'll hire a second person. But the second person doesn't quite learn quite as quickly. They don't have as much space, which means they work half as quickly. Again, our diminishing return on even workers. And because of that, we have an increasing in the costs without an increasing in output. What that means mathematically is that each additional output is actually costing us more. So initially you have the benefit of you have the initial increasing, and then you have your diminishing returns because you are increasing because producing one additional unit is actually costing you more because you've still got to pay your employee. But by the time you're hiring a second one, your productivity per employee also drops, and that increases your marginal cost. And that's why you get this U-shaped return. But we'll go into that in a little bit more detail later. Then your average costs about all your total costs. So that includes your fixed costs like your rental, your leasing of your machinery, the things you can't get away with, and then your variable costs, which are your materials and your labor essentially. And those are the things that increase with every unit you produce. So what we do is we put those two together, both fixed and variable costs. We get your total costs and we divide it by your output. Typically, you also have a U-shaped curve. What you'll find is that your marginal cost curve tends to increase at a steeper gradient, whereas your average cost curve is a lot more U-shaped. Okay, and the reason that happens is obviously initially, okay, it's always more expensive when you start producing. Because until that worker gets to those 10 units, they are still figuring things out. So you're paying them a wage of an expectation of 10 units of product, but they may take hours to sort of learn that. So by the time you start employing additional people, you had reached the minimum price, the marginal cost, when you had maximized your one employee. But if you don't track that, you'll add an extra employee also because it's the only way to increase the amount of product you can produce. Okay, so with average cost, the reason that its U-shaped curve is at a flatter gradient is because it is typically illustrating to you economies of scale. So economies of scale essentially say the more you produce, the more product there is to share the costs around. So if you are producing, for example, my daughter is now wanting to do Entrepreneur's Day. So she is making these little beaded bracelets. Okay, so I had to explain to her that the total amount of time that it takes her to produce those beads, okay, is her salary. That's the thing that we can't get away from. And then there is also the variable costs of the beads and everything she uses to produce the product. Now, as she gets more efficient at it, she achieves economies of scale, which means that she can produce more product in a quicker amount of time. So that would reduce her average costs because the part that she couldn't get away from was the amount of money that it was going to cost her to actually, instead of saying a salary, let's say what the market day will cost. Okay, so the more product she produces, the easier it is to split that 50 Rand entrance fee across all the products that she's produced. But if she's trying to maintain a profit line and only producing 10 bracelets, you would have to set your price quite high to make that a viable option. And obviously your average cost would be very high the fewer number of products you produce. Okay, but with economies of scale, and with her being more efficient, when she starts, took her a long time to produce a bracelet. Now she's much faster, so her marginal costs are currently coming down. But if I were to help her, then she'd probably have to explain everything to me. So we would have diminishing returns between the two of us. Okay, so in the short run, we have an equilibrium condition that gets set when, or you essentially are looking for profit maximization. That's why in the last learning unit, we looked at the purposes of a firm or the purpose of a firm. And one of those things is profit maximization. And we achieve this equilibrium situation when marginal costs equals your marginal revenue. Okay, so your marginal cost is the amount that producing one additional unit costs you. Your marginal revenue is the amount of money you receive from selling one additional unit. Okay, and obviously your market price is the price that is set. This is perfect competition, so you are a price taker. Okay, so your marginal revenue very often cannot exceed your marginal costs because then people will just go elsewhere. Profit status, you will achieve economic profits, normal profits, or losses, depending on where your price your price range lies. So essentially what they're saying here is in a perfect competitive market, just in case you guys encounter one or are participating in one, the key demographic or the key measure that we use is efficiency. It is return on equity, or return on your assets. How are you bringing down costs and squeezing that rock to get, the most out of the assets that you have available? So you can earn economic profits, but you have to drive your costs down. Your average and marginal costs have to be, it has to be optimal for you to still be sustainable in the long run. Okay, so profits are only maximized when you have, in the rising portion of your marginal costs, you have because you're producing beyond what it would increase. Sorry, hold on. Profits are maximized only when in the rising part of your marginal cost curve. So because you're producing beyond what you expect to, you would increase your costs more and you would increase your revenue more. So what we're trying to tell you there is the reason that you take on the additional marginal costs is because you do it in the hope of achieving additional marginal revenue. Okay, so obviously your cost curve, I will show you a better diagram, but you'll see that both of them tend to have this U-shaped curve to them. Okay, so there are profit scenarios in the short run. Okay, so you can make an economic profit, a normal profit, or an economic loss. Okay, these are the actual graphs. I just want to cover this briefly with you, and then, yeah, we'll probably do this in a little bit more detail, especially when we look specifically at these graphs, which very likely will come out in the exam. So if you are making an economic profit, you are in a very beneficial situation. And this only occurs when your market price exceeds your average total costs. Or your average costs. So your firm is then earning above normal returns. Okay, so what I will say though, the downside of that is that you end up in a scenario where you are like ChatGPT or OpenAI, because your profit or your price line is set above your costs and so significantly above your marginal costs. That indicates to everybody else that it's a great time to enter your industry. Okay, you will encounter an economic loss, however, when your price falls below your average total costs or your average costs in general. So here, let's just zoom in again. So here, where your average cost, so obviously this is implying that you are making a consistent loss. Your market price is set below the average costs it takes for you to produce that quantity of goods. Okay, and then here is our ideal situation. This is where your marginal cost equals your average cost equals your market price. In this scenario, you have achieved normal profits. It doesn't attract additional firms to enter your market, but doesn't cause you to exit your market either. Obviously, in the long run, because your average costs, everything is variable in the long run because you can make changes to your machinery, your plant, all of the big fixed expenses. So we will see the difference between those as well. So your firm and your supply curves in a perfect competition. So they correspond to the proportion of the supply curve above your average variable cost. So here, okay, if you look at this line, this is like your average variable costs. What that tells you is how much do you spend on average on only labor and materials to produce one product. Okay, then you've got your horizontal summation, this line over here, just the line that's the horizontal line that starts at your sorry, the horizontal line that starts here at 5. Okay, this straight line across here is a summation of all the individual firms. Okay, so that is your demand line or your supply line. That is what we can produce. But remember, we're still looking at the short term. Okay, so the market's supply and demand is determined by your equilibrium price and quantity in your overall market. So naturally, your interaction between your demand and supply is what decides the price, especially when you are a price taker in a perfectly competitive market. So in the long run, with perfect competition, what we want is zero economic profit. I know that is counterintuitive, but if you are not making abnormal profits, you are simply just covering your opportunity costs. You are maintaining the reason that it is difficult to be successful in a perfectly competitive market is because in the long run, you are just trying to minimize your risks, not necessarily maximize your profits. That's a more short-term way of thinking. Okay, so it's all about efficiency. It's about how your resource allocations, your price equals the minimum average cost. So how much profit can you possibly hope to gain if your average costs are not at the bare minimum of what they could be? So it's all about ensuring production and resource efficiency. Okay, the number of firms can also ensure that there is no incentive to enter the company. So, for example, I think you guys may have seen this maybe in marketing. We call that a red ocean market, okay, or a blue market, a blue ocean market. As opposition means that there's essentially no competition in the market that exists in the current industry. But with a red ocean strategy, it means that, it's already flooded with entrants. So in the long run, you are just trying to stay under the radar. You're trying to be Microsoft, not make any exorbitant, profits, but consistently just go up. Okay, so summary and key takeaways on perfect competition. Sorry, guys. Okay, so we want to be able to identify these market structures. So it's so important to recognize these defining features of perfect competition so that you can as soon as you can identify these specific characteristics, you know what type of market you're operating in. You understand that you are a price taker. For example, if you were to open a restaurant, a lot of companies don't understand that if you don't move yourself into a sort of oligopoly or monopoly sort of situation, you are like takeaways, you are substitutable. Okay. You have to be able to analyze your firm's behavior. So can you interpret your demand and cost curves to determine the profit condition? So essentially, if you can't manage your marginal costs and your average costs because you are a price taker, you will not reach economic profitability. And in the short run, that is what we're chasing, despite the fact that in the long run, we are pursuing zero economic profit. Okay, it's just a, very important caveat there. Okay, so it's also very important to understand different market dynamics. We have to be able to explain the formation of these supply curves, which we will do in a lot more detail, don't worry. Essentially, they're just saying that the reason that your supply curves are horizontal is because everything is variable in the long run. You can produce more machinery, which means that the reason that we make it horizontal, just like when we were looking at perfect elasticity, it was the one that had the like more horizontal slant. If you are if something is variable, we make it a horizontal line in that graph. So that's all we're trying to say, is that it is a summation of the supply provided by every player in the market. And that's how we get to our, total supply in the long run. Let me see. Okay. I think I can actually spend a little bit more time on this. Okay, guys. So I just want to look at these three graphs in particular. Okay, so what we see here in the normal profit section, right in the middle, is that here is your average cost curve. Okay, so what is important there is simply to remember that is your total costs divided by the quantity you produce. On your x-axis, you still have quantity or output, and on your y-axis, you still have price. Obviously, because you are a price taker, okay, it is a complete variable. That means that it is a horizontal line. Okay, it'll always manifest as a straight horizontal line, and that is the market price. You have no influence over it. It is an independent variable. Okay. Then you have your marginal costs. Okay, so here you can see the U shape that we were discussing earlier in your average costs, because initially at the smaller quantities, it's as we are producing, we have the benefits of these economies of scale. So people become more efficient at producing things. So it starts to drop the costs as we produce more. But inevitably, we need to still produce more product. However, we've sort of reached the barrier under which we can efficiently do that with one worker, so we employ someone else. That again will increase our average costs because we now are employing a whole second person who then still has to produce and learn this, from these economies of scale. So essentially the steepness of the upswing of your average cost is showing you this economies of scale. Okay, so then we have our marginal cost curve. All right, so initially you are simply decreasing costs while increasing product. So everything is, looking fantastic, but inevitably you hit a point where you get a marginal diminishing return, which means that your costs start to go up. So here originally you were, sort of figuring things out. You weren't producing at a very high quantity, but every unit you were producing was still, benefiting you in the long run. Your costs were only going to come down initially because you can only get better. But as you reach your point of diminishing marginal return, here the costs start to increase. You have to employ more labor to produce more units. You have to, you also are obviously increasing the production costs by increasing the materials that you're using. Okay, now we're going to look at, so the ideal situation there in the short run to maximize profits, you want your average cost curve, your marginal cost curve, and your price, your market price to all be equal to one another. Okay, so because obviously in this case, your price is equal to your marginal revenue and your average revenue as well. It is also depicting your total demand for your market. Okay, so this line, this price line, is actually indicating a number of things. The reason it is doing that is because we are operating in a perfect competition environment. So that means because we are a price taker, the amount of money that we receive from selling one additional unit is the price that the market dictates. It is also the average revenue that we receive because all of the products that we have sold, or the total revenue divided by the products we've sold. And how do we know that we've sold it? Because it is equal to our demand at this price. Okay, so when all of those things are equal to one another, and this will be a calculation and I'm sure a graph, I know it looks complicated, but it's just important to practice just drawing these curves and just understanding that these will be U-shaped curves, that you will only have one horizontal line, and that the variations are very slight. Okay, so you are only making an economic loss because of this one key thing. Here is your marginal cost. It is set to be equal to your market price. So at that, so there what we are saying is that your marginal revenue is equal to your marginal costs. Unfortunately, that leads to you receiving an economic loss. Why? Because your marginal cost is, and your price is still way below your average costs, which means that without economies of scale, which are shown by your average cost curve, this one over here, you would receive this economic loss shown here in this red block in this first graph. Okay. On the other hand, okay, so this obviously is not a sustainable situation. If you continue to produce, if your costs are not brought down, I'm sure those of you who work in industry have seen a lot of cost-driven initiatives, a lot of driving down the costs, a lot of lean manufacturing, a lot of lean processing. And the reason for that is because average costs is one of the single biggest determinants of your profitability of your company, both in the short and the long run. Okay, so here, okay, so obviously, also the reason that your marginal cost curve does this U shape very early is because originally your total costs are sitting right here. So you pay the rent, you've paid for the machinery. So already, despite the fact that you've only produced maybe one unit, you are still sitting with the entire cost on that one unit of output. So therefore, any increase in output would then sort of flatten your curve until you start to make this sort of recovery where your marginal costs are increasing, but with your product, with your output increasing as well. Okay. On the other hand, a supernormal phenomenon is supernormal profits. In this scenario, your market price is actually set above your average cost curve. That is an exceptional situation. It doesn't happen very often, but for example, the AIs experience this for a very short period of time. Their price level, the market price, the reason the market price was set above the average cost prices because we didn't really know. We had an idea of what it cost to produce, but we didn't really know what the potential of it was. So the market price was very difficult to determine because we didn't have perfect information regarding, participants in this industry. And you could see we really didn't have perfect information because all of their competitors then came out into the market. And we can see here the downside of having these supernormal profits is that firms start to enter your market. Why? Because you can almost immediately become profitable. Look how low your marginal costs were. This is exactly what happened with, for example, with DeepSeek. Okay, so initially they had to buy all the chips, they had to make all the farms, they had to, make all of the pre-existing infrastructure. Then they had to start producing outputs that were actually going to be beneficial. And then when they had to start training the bot, then they start hiring people because now they need it's becoming a more profitable thing. It does take a while, but you see that unless you can increase your economies of scale and unless you can increase your output, your business cannot grow. So it becomes a necessity to start increasing your marginal costs, because it is a great indicator that your production is increasing. And if your production is increasing, it means that your company is growing. So here, unfortunately, as soon as you see price and marginal costs are equal to one another, that's fantastic. Our concern is just then, where is your average cost curve? Okay, so you can see here in both supernormal and economic loss, the marginal cost and the price curve, your marginal revenue, average revenue, and demand, all in one, here are always equal to one another. However, where your average cost curve is, that is the determining factor as to whether you're making supernormal profits, in which case that intersection between marginal costs and price is above your average costs, or if you're making an economic loss, in which case the intersection is below your average cost curve. Okay, so I don't know if you guys have any questions on that. I just want to take a look at these. Okay. Okay, so what I have provided for you guys so far is that I have given you some just shortened versions of these notes, okay, just so that you can just peruse through them. It might be difficult to listen to an hour-long lecture, but perhaps just taking 5 to 10 minutes to just take a quick squiz through the lecture resources. It just summarizes all the information in the theme. So just the most important things to note. Here, I see already something that I've failed to mention is the criterion for market existence. Again, this is a nice 5-mark question, maybe even 10 marks if they ask you to explain it. So we obviously have covered this before. Very early on, I think it was in Learning Unit 2 when we looked at perfect competition as well. You need a large number of willing buyers and sellers. You need goods and services available for exchange. You need some sort of natural pricing mechanism. You needed a fair price to be able to be established by the market because there were a large number of buyers and sellers. And of course, access to market information. Okay, so those are your 5 key criteria for perfect competition and markets in general, free markets. Okay, so decisions for equilibrium. So as you as the company are going to be managing the costs of production, Pricing is very much set by industry. It's set by your demand and the interaction between demand and supply. So you have no influence there, but you have to understand your pricing versus your output levels, your production, and your costs so that you can maintain profitability both in the short and the long term. Obviously, in the long term, you just want to not make a loss. Okay, you don't want to make your industry look too appealing by setting your prices to or to setting your, having your average cost curve be too far below the market price, in which case there's no equilibrium there. Or to be at the disadvantage of having the opposite, where you are making an economic loss and getting forced out of your own industry. You don't want to attract too many people. You don't want to get forced out yourself. So in the long term, we're looking for zero economic profit. Okay, so there is a shutdown rule, and that is with regard specifically to production. So when we did a lot of learning unit 7, we focused on things like productivity per worker. And we looked at the law of diminishing return with regards to improving or increasing labor head, for example. Now, there is a key point in your production. When your average revenue is below your average variable cost, that means that it is costing you more on average to produce a product, more in specifically labor and materials than you can hope to receive from an average revenue, which would be your market price. Okay, at that point, it is useless to continue producing. We have to shut down. We have to cease production because producing more is not going to cover the cost of producing the product. Okay, variable costs will always stop when production ceases. You guys will see that. We live in South Africa, so we experience strikes. Or I haven't in a while, but you guys remember the good old days. When that happens, the plant still runs. They still pay for the land. They still pay for the machines to be maintained. The only thing that stops is the variable costs. So there's no direct materials and there's no labor that's being paid. So the decision is to minimize losses in the short run, obviously. That's why we're always trying to get people to not go on strike, because it's inevitably bad in the long run for everyone. Okay, there's obviously the profit maximizing rule, which we covered earlier. How we achieve profit maximization in a company is we've got to make sure our marginal costs are equal to our marginal revenue. So the amount of money that we are spending to produce one additional unit is the amount of money guaranteed that we are going to get from selling that product. Okay, so at that point, we are now making the maximum allowable profit economically speaking. Okay, obviously, if you skew this and you start maximizing your profits by maximizing revenue and minimizing your costs, then you start to create a more competitive industry, and then eventually more people enter your market and the price gets reset anyway. So the restrictive conditions for perfect competition, just a quick summary again. All your products are homogeneous. Identical products. There's no differentiations, which means they are perfect substitutes for one another. There must be many different firms, which means that no one firm can influence the price or the market price. There has to be perfect information, complete transparency, and no barriers to entry. Okay, so despite this restrictive model, it is because it focuses on efficiency of resource allocation and consumer welfare, it has some major long-run benefits. Okay, so here's where we cover the curves in a little bit more detail. So here, just re-emphasizing that where we reach this profit maximization is where your marginal cost equals your marginal revenue equals your marginal or your market price. Where there is a positive difference between total revenue and total cost, that means that you've made a profit. You guys remember that from Learning Unit 7, and I'm sure you guys have known that from business for years. It is simply the difference between profit is simply the difference between the revenue you make and your expenses or your costs. There is a difference between normal profits and economic profits. Okay, so normal profits are just the minimum profits necessary for the business to remain in business. Okay, it just covers your costs. It is break-even point. Okay, so that is your minimum profit, your normal profit. Your economic profit, however, okay, that is the surplus of remaining. So that is the part that we consider to be at risk. Okay, so if you are running at an above normal, a supernatural cost, or a supernatural profit level, we call that economic profit. Okay, so economic profit is unlike normal profit is essentially your break-even point here. But your economic profits are the things that go beyond your implicit and your explicit costs. Okay, so here's your break-even point. I'm sure you guys may have encountered this before, but just to restate it here, that is the point in your business where your total revenue equals your total cost. At that point, you are making zero profit, making zero losses. But from that point, graphically, this is where your total revenue curve would intersect with your total cost curve. But this is a very positive thing for a business because from this point, you are profitable. So let's go. Okay, so there we go. The firm supply curve is the portion of the marginal cost curve above the average variable cost curve. So it is, okay, we're going to look at this in a little bit more detail because I actually would like to draw this graph out for you because it is, while it's very simple to understand, it is simply the horizontal summation. So it is the horizontal flat line. That is represented or represents the market supply in the long run. But we will look at these specific graphical illustrations and I will draw these curves for you guys. Okay, and then our last theme. Sorry, just want to make sure that we've covered all of our learning objectives apart from the graphs. Okay, so in the long run, what's important is that firms obviously want to try and produce at the lowest average cost. They want no economic profits, but what they are mostly focused on is driving down costs, allocative efficiency. It is very easy to enter and exit this market, which is why it is so important to be fair in the long run so that you create a sustainable business. Because if you are, if your costs exceed the market prices, you cannot exist for very long, running at a continuous loss. And if you're listed on the stock market, they will certainly penalize you for it. There is obviously a dependence on normal profits. This is the point of break even, but additionally to that, it includes your opportunity cost. So at this point, you have now, the money has been well invested. It has gotten all the money that you have invested has brought back the equal returns. So at this point, you have been compensated adequately for the resources you have expended. Okay, there are going to be changes in individual firms. So there will be, as we saw in many tech companies specifically, there are major cost reductions that come with technological advancements, and that can very often impact your market price and your market equilibrium. Think about DSTV or PlayStations a few years ago. They continuously get cheaper. It becomes more efficient to produce them. They achieve economies of scale, and that's why they are able to maintain their profitability over the long run. If, however, you have costs that continue to increase, you are achieving diseconomies of scale, which means that you are not becoming more efficient, you're becoming less efficient. So if you employ additional machinery, for example, and your productivity doesn't continue to increase, you're not producing outputs for the amount of costs that are going into it, then it's very often that you will scale back your production. It's very important to have a benchmark. The reason we do that is in the real world, we try to compare apples with apples, but comparing tech companies and finance companies is quite difficult. So we tend to pick benchmarks within an industry, just so that we can sort of get a true reflection of what's really happening when we look at the market price. Okay, last section of this learning unit, apart from the graphs. The allocative and productive efficiency, of course, becomes critically important. We do see the downside of this. When we became extremely efficient just before COVID, it made it very difficult to change our supply lines when we needed to. So they become quite cemented because we are trying to maximize societal welfare. So it becomes very sticky, very difficult to change these things. So there is allocative efficiency, and that's where we're looking at where are the resources being distributed to. So where does price equal your marginal cost? That's where you've achieved allocative efficiency. With production efficiency, you rather achieve production efficiency when you are producing at the lowest possible cost, which means the minimum point on your average cost curve. That includes both your fixed and variable costs. What is the point at which you optimize the amount of goods you need to produce in order to minimize the production costs? And efficiency is of course, you guys can also do a little bit of research. Efficiency in perfect markets is a basic assumption. Both allocative and productive efficiencies are achieved. So we want to produce at as low a cost as possible, and we want to deliver the most value for the consumer, the allocative efficiency. That's where all the lean mechanisms or lean theory comes in, is that we work backwards from what the customer actually values and eliminate everything else. Yeah, okay, guys, I've gone 2 minutes over time, but we have covered the entire learning unit from what I can see. But as always, we will cover monopoly and imperfect competition in our next session together. And then after that, we're going to spend quite a bit of time on just focusing on the graph so that you guys are comfortable with all the different variations within both perfect competition and monopoly situations, because unfortunately the graphs do differ. But let me just check if there are any questions. Great, guys. If there are no questions, then thank you again for joining me. I really appreciate it. If you guys have any questions, please feel free to email me. I'm so sorry I've been a bit out of the loop. If I still owe you an email, please feel free to pester me. I have had some medical issues recently, so that's what's caused a bit of a delay. But you guys are still a priority for me, so please, if I miss your email, please